What if I told you that every time you click buy on your favorite zero commission trading app, you are actually still paying a hidden tax?
Yeah, that's a truth a lot of people don't want to hear.
Right? Because we live in this era where financial platforms just bombard us with the promise of completely free trading. I mean, they gamify the experience, making it seem like you can jump in and out of the market without any friction whatsoever.
Absolutely. It feels like a video game.
It totally does. But the reality is there is an invisible cost built directly into the plumbing of the financial system itself. A cost that quietly drains your account while you are, busy staring at flashy indicators.
So welcome to the Franks Report, where we take a deep dive into the modern financial markets, cutting through the noise to find the strategies that actually work. I'm Jessica.
And I'm Philip. Before we pull back the curtain on these hidden market mechanics, make sure you hit that follow button wherever you're listening so you never miss out on a future show. Also, if you are looking to seriously upgrade your trading toolkit, you absolutely need to pick up a copy of our new book, The Funded Micro: Modern Future Strategies for the Prop Firm Era. It is available right now.
Yeah, it was a massive labor of love, pulling together years of practical execution strategies. I am genuinely thrilled to finally share it with everyone.
I am so excited for people to read it. And we also have a huge shout out to our sponsor, TradingView. Their slogan is the fastest way to follow markets, and they truly live up to it.
We really do.
If you want to obtain the business standard when charting your trades, you can actually save $15 by using our referral code down in the description. All right, so let's talk about today's mission.
Let's do it.
We're looking at a huge stack of sources today. It's a mix of market microstructure articles, some heavy academic research, and our own internal notes. And we are speaking directly to you, the listener. Whether you are completely new to the markets, or maybe you've been trading for a while, but feel like your profit margins are inexplicably shrinking, this deep dive is for you. We are skipping all the secret chart patterns today. We're focusing entirely on the actual physical mechanics of a trade.
And that illusion of free trading that you mentioned at the start, I mean, that is arguably the most dangerous trap for a beginner.
Oh, for sure.
Because usually when people calculate the cost of a trade, they just look at the broker commissions. They think, well, my broker charges $0, therefore my trade is free.
Right. The math seems simple.
But every single financial transaction involves friction. It is just a fundamental law of markets. We call it the transaction tax. And it all starts with a concept that every trader sees on their screen, but very few deeply understand. And that is the bid-ask spread.
I want to try and unpack this without sounding like a college finance textbook, because the mechanics here are actually pretty intuitive when you just, strip away the jargon.
They really are.
When you pull up a stock on your screen, you don't just see one single price tag like you would on a gallon of milk at the grocery store.
There's no fixed sticker price.
Exactly. You see two distinct prices, the bid and the ask.
Think of them as the two opposing forces of the market. The bid is the absolute highest price a buyer is currently willing to pay for that asset. It basically represents the immediate demand.
Okay.
So if you are holding shares of a company and you suddenly panic and you decide you need to sell them right this very second, you are going to be forced to sell to whoever is sitting at that bid price.
And the ask is the exact opposite of that. That is the lowest price a seller is willing to accept to part with their shares. It represents the immediate supply.
Spot on.
So if I am sitting at my computer feeling the FOMO and I demand to buy an asset right now, I have to pay that ask price.
Yeah, you pay the premium. And the crucial mechanism to grasp here is that in a functioning, orderly market, those two prices can never equal each other. They literally never touch.
Because if the highest buyer and the lowest seller suddenly agreed on the exact same price, a transaction would just trigger instantly, right?
Exactly. The orders would execute, they would vanish from the order book, and a new gap would instantly form between the next highest buyer and the next lowest seller in line.
Wow, okay.
That permanent gap between the bid and the ask, that is the spread, that's the transaction tax, and it is paid directly to the market makers. You are essentially paying them for the luxury of immediate execution.
Let's put some real tangible numbers to this, because when you just look at the spread on a screen, it feels microscopic.
It does, yeah.
Let's say we are looking at a stock and the bid is sitting at $150.20. The ask is at $150.25. The spread is a mere 5 cents. To a beginner, 5 cents feels entirely irrelevant.
It feels completely irrelevant right up until you scale your position. I mean, imagine you decide to buy 1,000 shares of this stock.
Okay, 1,000 shares.
Because you're demanding those shares immediately, you are forced to pay the ask price of $150.25. But think about what happens the very millisecond those shares arrive in your portfolio.
Right.
What are they actually worth if you changed your mind and had to liquidate them immediately?
I would have to sell them to the buyers sitting at the bid price, which means I could only get $150.20 for them.
Exactly.
So on a 1,000 share position, that tiny 5-cent gap means I am instantly down $50. I literally start the trade with an immediate, unrealized loss.
You are digging yourself out of a $50 hole from the exact moment you click the button. The asset actually has to move in your favor by the entire width of that spread just for your account balance to get back to zero.
I was actually thinking about this while reading through the research notes, and it reminds me of those currency exchange booths you see at the airport.
Oh, that's a great comparison.
Right. You walk up to the glass, and they have that digital board showing 2 different exchange rates. If you want to buy euros for your vacation, they sell them to you at a premium rate.
Yep.
But when your trip is over and you want to convert your leftover euros back into dollars, they buy them back from you at a discounted rate. The booth just sits in the middle, providing the convenience of an instant swap, and they pocket the difference.
The currency booth is the perfect real-world equivalent of a market maker. I mean, they are offering you liquidity. You don't have to wander around the airport terminal looking for a European tourist willing to hand you dollars for your euros.
That would be so awkward.
Right. The booth takes the other side of your trade instantly, but they tax you for that convenience. Market makers in the stock or futures markets are doing the exact same thing. They just do it algorithmically millions of times per second.
Which opens up a huge question about how this ecosystem actually breathes. Because that gap, that spread, it isn't static. It is not a flat 5 cents for every single asset in the world.
Not at all. It fluctuates dramatically depending on what you are trying to trade, which introduces the core concept of liquidity.
Right.
In market terms, liquidity is simply how quickly and easily you can convert an asset into cash without moving the overall price of the market.
So a highly liquid environment would be something massive, like a major currency pair, say the euro against the US dollar, or maybe a mega cap tech stock like Apple.
Exactly. In those arenas, you have a staggering number of participants. You have high-frequency trading algorithms, massive institutional banks, retail traders, all just fighting tooth and nail to get their orders filled.
It's crowded.
Very crowded. And because there is such fierce competition to provide the best price to the market, the spread compresses. The gap between the buyers and the sellers gets squeezed down to the absolute smallest increment allowed by the exchange. We call that a tick or a pip.
It is incredibly tight and efficient.
Yeah.
But then the research notes point us to the other end of the spectrum, which is illiquid markets.
Yeah, that's where things get dangerous.
We are talking about obscure small cap punny stocks, or maybe exotic emerging market currencies. The spread in those arenas isn't just one tick. It can be a massive canyon between the bid and the ask.
Huge.
But hold on, let me push back on this a bit, because this is something that always confused me when I first started learning about market structures.
Sure, go ahead.
If an illiquid market is so toxic and the spreads are so wildly expensive, why do market makers even bother participating in them? With all these high-speed algorithms, aren't they just taking on unnecessary risk? Like, why not just stick to trading Apple where all the safe volume is?
That's a really valid question, but you have to look at it from the perspective of their business model and the reality of inventory risk.
Okay.
A market maker's job is to constantly buy from sellers and sell to buyers. To facilitate that, they physically have to hold an inventory of the asset on their own books, even if it is just for a few seconds.
Right, they have to hold the bag momentarily.
Yes. So if a market maker buys a massive block of Apple stock, they know with near absolute certainty that they can offload it a millisecond later because the global demand is endless. The inventory risk is basically zero.
But if they buy a block of some random low-volume penny stock,
The music stops.
Yeah.
If a seller dumps a huge block of a random penny stock onto a market maker, there might not be another buyer who comes along for 10 minutes, an hour, or maybe even the rest of the trading day.
wow, really?
Yeah. The market maker is now stuck holding a highly volatile, toxic asset that they cannot easily get rid of. That is a terrifying amount of risk for a financial institution.
Oh, I see. So the massive spread is essentially their insurance policy.
Exactly. It is their compensation for danger. If they're going to do you the favor of taking that illiquid garbage off your hands, they are going to buy it from you at a painfully steep discount.
And if you are demanding to buy it from them, they are going to charge you an extortionate premium.
You got it. And that wider spread completely changes the mathematical viability of a trade. You would need the asset to make a massive directional move in your favor just to cover the cost of that spread and break even.
So up until now, we have been talking about the theoretical cost of the spread sitting statically on a computer screen. But the research notes take a sharp turn into what happens when theory meets reality.
Right, because the market is a living, breathing thing.
Exactly. What actually happens the moment a trader physically clicks that buy button?
That brings us to the very real danger of market impact and slippage. Slippage is the mechanical difference between the price you were looking at when you initiated the order and the actual price where your broker filled the trade.
I know so many new traders who experience slippage for the very first time, and their immediate emotional reaction is just anger.
Oh, they feel cheated.
They totally do. They think, I clicked buy when the price said $50 flat, but my portfolio says I bought it at $50.05. My broker is actively stealing from me.
It is the most common misconception in retail trading, but it rarely has anything to do with a malicious broker. It is just the physical reality of how a market order interacts with a constantly moving limit order book.
Oh.
Well, if you send a market order instructing your broker to buy a stock at $50, but the market is heavily volatile and moving incredibly fast, there is a transit time.
Like a lag.
Right. By the time your digital order physically reaches the exchange's matching engine, that seller offering shares at $50 might already be gone. Some other algorithm beat you to them.
Oh, man.
So the matching engine just looks for the next available seller, who might be sitting at $50.05. So your order gets filled there.
You suffer negative slippage. You bought higher than you expected to. And those 5 cents are an additional friction cost, stacked directly on top of the bid-ask spread we just broke down.
Precisely.
If you are trading actively and you are constantly bleeding an extra 5 cents here and maybe 10 cents there, that friction will absolutely bankrupt a seemingly winning strategy.
It ruthlessly destroys profit margins over a large sample size of trades. Now, just to be totally comprehensive, positive slippage does exist.
Right. It goes both ways sometimes.
Yeah, sometimes the market rapidly moves in your favor during those milliseconds, and you get filled at a better price than you expected. But you cannot build a sustainable, long-term business model relying on the hope of positive slippage.
Hope is definitely not a viable trading strategy. And the research highlights that this slippage problem gets exponentially worse when we start talking about larger position sizes. This is where we get into the concept of market impact.
This is a big one. A lot of retail traders operate under the illusion that an order of any size gets filled instantly at a single uniform price.
Which makes sense if you're small.
Right. If you were buying 10 shares of Microsoft, that is generally true. But what happens when an institution or even just a well-funded retail trader wants to enter a significantly larger position?
The scenario laid out in the source material for this is incredible because it perfectly visualizes the mechanics of the limit order book.
Walk us through it.
Okay, so imagine you want to buy 5,000 shares of a specific stock. You check your screen, and the ask price is currently sitting at exactly $10.
So you assume you are going to pay $50,000 total. You place a market order for those 5,000 shares. But the reality of the order book is that there might only be 1,000 shares actually sitting at that $10 price level offered by various sellers.
So your massive order slams into the market and instantly eats up those 1,000 shares. The $10 sellers are completely wiped out.
Right.
But your order is only partially filled. You still demand 4,000 more shares.
Yeah.
What does the exchange do?
Your order begins what we call walking the book. It aggressively moves up the ladder to the next available price level to hunt for more sellers.
Okay, so it just keeps going.
Yep. Let's say the next group of sellers is offering their shares at $10.01, and combined, they have 2,000 shares available. Your order aggressively sweeps all of those up. You now hold 3,000 shares, but you still need 2,000 more to complete the order.
So it walks up the ladder again. It hits the next level at $10.03, grabs the final 2,000 shares there, and the order is finally complete.
The order is complete, but your average fill price is a blended average of all those different levels. It is significantly higher than the $10 you originally saw on your screen.
Wow.
You actively push the market price against yourself simply because the sheer size of your order overwhelmed the liquidity available at the best price.
Okay, visualizing this limit order book, it feels exactly like going to a local bakery on a Sunday morning and trying to buy a full dozen donuts.
Oh, I like this analogy.
You look in the display case, and they only have 3 of the standard cheap glazed donuts left. You tell the cashier you need 12 donuts no matter what. So to fill your box, you are forced to start picking out the premium, expensive, jelly-filled ones.
Right, because that's all that's left.
Your average cost per donut skyrockets. Not because the base price changed, but because your demand exceeded the supply available at the lowest price tier.
That bakery dynamic is exactly what happens in the financial order book. When your position size exceeds the available liquidity at the best price tier, the market forces you to pay a premium to fill the rest of your box. You are consuming the market's liquidity, and you pay dearly for it.
So if this combination of the spread, slippage, and market impact can do so much structural damage to an account, how does a trader actually defend themselves? We can't just cross our fingers every time we interact with the market.
Defense comes from taking absolute control over how you instruct your broker to behave. And that means mastering order types. While there are dozens of complex variations, a trader's defense mechanism primarily boils down to 2 distinct tools: market orders and limit orders.
We have spent a lot of time analyzing market orders. When you utilize a market order, you are prioritizing speed and certainty of execution above all else.
Exactly.
You are essentially screaming at the broker, I don't care what the slippage is, I don't care about the spread, just force me into this position right this second.
In industry terms, you are crossing the spread. You are aggressively taking the current ask to buy or slamming the current bid to sell.
It's brute force.
Total brute force. A market order guarantees that you will get your shares, but you completely surrender all price protection. You leave yourself wide open to the full width of the spread and whatever brutal slippage the market wants to hand you.
Contrast that aggressive posture with limit orders, which prioritize price protection over the certainty of execution.
A limit order allows you to draw a hard line in the sand. You dictate to the exchange the absolute maximum price you are willing to pay or the absolute minimum price you are willing to accept.
Okay.
So if you want to buy a stock, but you refuse to pay a penny more than $50, you submit a limit order at exactly $50.
And the brilliant part about doing this is that you are no longer crossing the spread. You stop demanding immediacy. You are actually stepping up and acting as a liquidity provider yourself. You are joining the bid.
You become part of the market infrastructure. And if the price naturally drifts down to your $50 level, your order gets filled.
That's great.
By doing this, you completely circumvent paying the market maker's transaction tax, and you eliminate negative slippage entirely because the exchange is mathematically prohibited from filling you at a worse price than your stated limit.
But let me play devil's advocate here because the trade-off seems massive.
It is.
If limit orders offer this perfect, impenetrable shield against slippage and spreads, why in the world would any trader ever use a market order?
The trade-off is the very real risk of non-execution. With a limit order, the market might come down to $50.01, reverse, and rally 20% without you.
Well, that hurts just thinking about it.
Right. You were perfectly right about the direction of the market, but you completely missed out on the profit because you stubbornly held out for one single penny. Traders use market orders because the psychological pain of missing a massive move, the fear of missing out, overrides their desire to save a few cents on the execution.
FOMO is an incredibly powerful driver. But the research notes emphasize that getting into that FOMO is especially catastrophic during periods of high volatility. And this is a crucial dynamic to understand because we established earlier that spreads are not static. They breathe.
They breathe, and sometimes they hyperventilate.
Wow, okay.
During normal, calm trading hours in a liquid asset, the spread is tight and highly stable. But consider what happens during a major macroeconomic news event. Think about the exact moment the Consumer Price Index data is released, or the non-farm payrolls report hits the wires.
Complete chaos. Algorithms go crazy.
Absolute chaos. In that split second, extreme uncertainty floods the entire financial system. The price of an asset can swing wildly by massive percentages in milliseconds. Now, put yourself in the shoes of a market maker.
Okay.
You are contractually obligated to provide quotes to the exchange, but you have absolutely no idea what the true, fair value of the asset is at that exact moment. You are facing an existential level of risk.
So they go into the survival mode?
They protect their firm's capital by aggressively pulling their orders back from the current price, or they drastically widen the gap between their bid and their ask. An asset that normally has a 1-cent spread can instantly balloon to a 10 or 20-cent spread in the blink of an eye.
So if a retail trader gets caught up in the excitement of a news release and they blindly throw a market order into that specific window of time, it is going to be brutally expensive.
Extremely.
You could find yourself down 1 or 2% on your entire position size instantly just because the spread expanded to protect the market makers from the volatility.
It is a mechanical trap, and it catches inexperienced traders every single day.
So we have dissected the bid, the ask, liquidity, slippage, and order types. Let's bring all of this together into what the source material labels the professional playbook.
Yeah, let's get practical.
How does a professional trader actually calculate their true bottom line? And what are the practical rules we can implement to defend our capital?
The transition from amateur to professional begins with changing how you measure the cost of doing business. You can no longer just look at a broker's commission statement. The true metric you need to track is your total transaction cost.
Okay, what goes into that?
This is the sum of three distinct variables. First, any commissions or regulatory fees. Second, the realized spread, which is the actual gap between the midpoint of the market and the price you were forced to pay. And third, the cost of any negative slippage you suffered on the entry and the exit.
If your strategy relies on scalping, jumping in and out of the market for tiny, quick profit targets, those hidden friction costs could easily eat up 50% or more of your expected gain. It fundamentally breaks the mathematics of your strategy.
Which is exactly why discipline is non-negotiable. The research material outlines 5 practical strategies for friction reduction.
Let's hear them.
Rule number 1. Exclusively trade highly liquid instruments. Stick to assets with massive daily volume and razor-tight spreads. Let the algorithmic competition work in your favor.
Okay, that makes sense. Rule number 2. Default to using limit orders. Have the discipline to let the market come to your price. Suppress the emotional urge to aggressively chase a running market with market orders.
Rule number 3. Avoid high volatility windows. Unless your specific edge is built entirely around trading news releases, stay completely out of the market during major economic data drops.
Just sit on your hands.
Exactly. Furthermore, exercise extreme caution during the first 5 minutes of the market open when overnight orders are flooding the system and spreads are notoriously wide and unstable.
Rule 4 is something we touched on with the donut analogy, and it's fascinating in practice. Monitor the order book. Actually look at the level 2 data or the depth of market, the DOM.
Such a powerful tool.
It really is. This gives you X-ray vision into the supply chain. You can literally look at the DOM and see the exact number of shares sitting at every single price level.
It removes the guesswork. If you need to buy 5,000 shares and you consult the level 2 data and clearly see there are only a few hundred shares available across the next 5 price levels, you know for a mathematical fact that sending a market order is going to cause massive slippage.
Right.
It allows you to anticipate your own market impact before you ever click the button.
And finally, rule number 5, pay attention to the time of day. Liquidity is not a constant force around the clock. The markets reach peak liquidity when major global financial centers overlap, like when the New York and London sessions are operating simultaneously.
Yep, the golden hours.
If you try to force trades in U.S. equities during the late Asian session, you are operating in a liquidity desert, and you will pay for it with dramatically wider spreads.
When you adopt this framework, when you start treating the spread and slippage as real, tangible supply chain expenses, it completely evaporates the gambling mindset. You stop viewing trading as a casino, and you start managing it like a professional logistics business.
Because every single cent you save by optimizing your execution is a cent that drops directly to your bottom line. Preservation of capital doesn't just mean knowing how to pick the right direction on a chart. It begins long before the trade even plays out. It starts with rigorously controlling the mechanical friction of the entry itself.
If the combined cost of the spread and the expected slippage represents a massive chunk of the distance to your stop loss, the trade simply isn't mathematically viable. You are taking on too much risk for too little potential reward.
That is such a grounded, practical way to look at the markets. And that is the biggest takeaway for you today. Protecting your account starts at the mechanical level, with the invisible plumbing most people ignore.
If you want to dive deeper into these execution concepts and learn how to build robust strategies around them, make sure you visit franksreport.com. And again, I highly recommend checking out the book, The Funded Micro, Modern Future Strategies for the Prop Firm Era.
And be sure to follow the show wherever you are listening so you don't miss our next deep dive into the markets. But before we sign off, we want to leave you with one final thought to mull over.
Yeah, think about this.
We spend so much time and energy obsessively searching for the perfect technical indicator or the ultimate chart setup that will predict the future. But what if the biggest edge in trading isn't having a crystal ball for where the price will go, but simply mastering the boring mechanical discipline of exactly how you enter and exit.
The friction is the invisible game being played right in front of you. Once you learn how to see the matrix, it changes how you approach the market forever.